Attracting investment from funds and engaging with your investors are two of the most important activities for quoted companies. We're pleased today to have with us 3 small and mid-cap fund managers who are going to share their views on what they look for when investing, and they'll also give you some insight into how they like to engage with the companies that they invest in. This panel is a great opportunity to find out their view of the market and also to quiz them on how to optimize liquidity. Here to chair the panel we have Dick Steele, who's chairman of Portmeirion Group plc, an AIM quoted company, and he's a board member of the illustrious Quoted Companies Alliance. Join me in welcoming Dick and our panel.
Thank you, Tim. Well, good morning, everybody. This is quite a turnout. It's nearly as big a turnout as I get for my annual general meetings, but I might be lying on that one. Tim's introduced me, Dick Steele. I have the honour to chair Portmeirion Group plc. It is AIM listed with a market cap of about 70 million, and we are proud members of the QCA. The conference title is Engineering Growth for Small and Mid-Cap Companies, and this particular session is entitled How to Optimise Liquidity in Your Company. And here joining me on the panel are 3 seriously heavy hitters from fund management, whom I shall introduce in turn. We have 75 minutes for this session, approximately 10 minutes from each of them, and then a Q&A session at the end, so please hold back your questions until the end. Now, those of you who attend the invaluable QCA fund manager luncheons will be aware of the pearls of wisdom that we're able to take as they absolutely gush from the mouths of people such as these. And those of you who don't attend those luncheons, I really would recommend so to do. Liquidity is the flip side of price. A fair price on your shares requires an optimal liquidity. An optimal liquidity requires a fair price. And both enable ease of fundraising, capital to grow. And we know that we need 4 things for economic growth, and that's basic economic education, that which we really do know: labour, land, business nous, and capital. An optimal liquidity is important for raising capital, and I would actually argue that we as directors have a fiduciary duty to ensure that there is liquidity in our stock market shares. This much is sucking eggs, you do understand it. And in getting liquidity, there are certain macro points to cover off. We are blessed here in the UK with one of the most efficient and effective equity capital markets in the world, if not the most. We have political, geological, climatological and geographical stability and a working legal system. On top of that, as smaller companies, whether we're smaller end of the main market or on the AIM, we are blessed with the QCA to fight our microeconomic corner. Just 2 weeks ago, Tim took a number of QCA members to the Treasury to explain how fundraising can and should be improved. The QCA were instrumental in getting stamp duty removed from AIM shares, though it doesn't apply till next year. And they are pushing hard to get AIM shares into ISAs, and you've heard this morning that the government are consulting on putting AIM shares into ISAs, though how much consultation that takes is almost beyond me, and I think the Treasury can consider themselves very fortunate that they don't work for me, because I would be quite short-tempered about it. It's yes or no, isn't it? It's yes. These all improve liquidity either by allowing another investment type or by reducing the cost of investment. And one of the features of a market is liquidity. No liquidity, no market. So before turning to each fund manager in turn, I'm going to tell you a little bit of the Portmeirion story, because it is instructive and I think it should help stimulate discussion. We make the finest tableware in the world, cups and saucers. We are not based in Wales, and I could get you to use your little voting things and press a 1 if you think we come from Wales. We're based in Stoke-on-Trent, and we export to over 60 countries worldwide. We were founded in 1961, although the oldest brand in our portfolio was established in 1751, that is Royal Worcester. And indeed, the oldest pattern which we've been making continuously is an 1816 pattern called Spode Blue Italian. 3/4 of what we sell goes abroad, and exports, as we know, are vitally important to our growth. We are design-led, quality is vitally important, we nurture our brands, Portmeirion, Spode, Royal Worcester and Pimpernel. We are financially prudent, we make profits, we generate cash and we pay dividends. We hit our market forecasts and we comply or explain. Management remuneration is closely linked to shareholder returns. I don't tell you those things because I'm proud of what we do. I am. The reason I tell you is because those are the punchy things you've got to get across to these boys in the first minute or two of your presentations when you go to meet them. They are the key messages which we seek to get across to all fund managers as often as we possibly can. And your key messages should be the same or similar but different for the industry specifics. And let me just play back to brands for a minute. I think it's quite important to treat your share price as a brand. It has inherent values which you should seek to maintain. So think of your share price as a brand. It's a promise which you deliver on. We floated on the full list in 1988 and we went down, or perhaps sideways, to the AIM market, a far more appropriate place for us, about a decade ago. 6 years ago I became chairman, and we're going to have a talk about corporate governance later on, certainly one of my bugbears. And at the time when I became chairman, our share price was moribund. Turnover and profits were static or falling. Volumes in our share price were minimal. Most days, no shares were traded. Now, over the last 6 years, we have had a lot of luck as a business. The nadir in our share price was about £1.20. Our lowest market capitalisation, about 13 million. And it was a rare day when any shares were traded. The proper fund managers were not in our shares, and we spent no time at all on investor relations. Today our share price, well, 2 days ago when I wrote this, was £7. It's still approaching £7, and our market cap is £70 million. I cannot remember the last day that there was no turnover in our shares, and the average daily transactions are over 30,000. We have a number of very respectable fund managers. Aren't they all respectable? But we have a number of very respectable fund managers in our shares and in growing amounts. And this becomes a snowball factor, and perhaps we will get onto that later. We commit about 10 formal senior management man days a year to investor relations, the dog and pony shows that we all know as we traipse around London or Edinburgh or indeed elsewhere. And indeed in Stoke as well, because I have a factory that we can show people. We have changed broker stroke nomad twice, and the last time to Panmure Gordon, which was a very successful move for us. We have appointed financial PR, Pelham Bell Pottinger, which again has been a very successful move for us. We have assiduously courted the press. We have a very photogenic product. In fact, the argument in Stoke is whether which is more photogenic, the product or the chairman. And we have courted private shareholders and private client brokers because they are important as well. Here's a thought for you. I personally send a letter to every new private shareholder who comes on the register. I don't think there's many companies do that. I think it's an important thing to do. We've worked hard on our presentations, and we have listened to these clever fund managers when they've given us their views. We treat our shares as a brand. Consistency and consistency. Consistency of message and consistency of delivery. Deliver what you promise. Quality. Well-designed tableware, sold worldwide, generating profits and cash, paying a growing level of dividends with a prudent level of cover. Have I mentioned those things before? These are the brand attributes of our shares. We are not yet where we want to be in terms of market cap, but we are getting there, and we have had a good journey so far. And I am confident that if I wanted to raise money on the AIM market tomorrow, providing the story was a good story, Pammy or Gordon could deliver that money raising for me. Now let us turn to the three fund managers whom we've been fortunate, very fortunate, to get here today and seek their views. I shall introduce each in turn and ask them to answer a few formal questions for about 10 minutes. After I have spoken, I shall throw it open to all of you for Q&A. In order to add a little piquancy to the proceedings, and perhaps to the Q&A sessions once all the fund managers have had their say, it is important to know, a la Paddy McGuinness in Take Me Out, I don't know if anybody watches Take Me Out, I find it absolutely compulsory viewing on a Saturday night. It's important for you to know that one of the panellists is training to be a florist, and one of the panellists enjoys ballroom dancing at the weekends, and you need to work out which is which. Now, if you turn to FE TrustNet, and it's probably a good thing to do that before you go and do a fund manager presentation to find a little bit about the enemy on the other side of the table, you can learn about these gentlemen. The first one who's going to speak is Richard Penny. Richard has a degree in engineering and economics from Cambridge. He started his investment career in 1992 and has been a fund manager since 1994. Most recently, he's been the manager of Legal & General UK Alpha Trust and winner of the Money Observer Best UK Growth Fund Award 2009, 2010, 2011. The fund is an aggressive stock-picking fund looking for investments that can double or more over 3 years. It uses a mix of deep value and strong growth strategies. Wow, what a gunslinger. So, Richard, do you want to come up here or do you want to stay there? Or do you want to stand up?
What's best?
Whatever you want to do.
I'll go to the podium.
Okay. And my first question to you, Richard, is what is your investment time frame?
Generally speaking, to answer that question, if I say a little bit about the funds that Legal & General runs, about a week ago it was a sort of round £1 billion. It's probably somewhat less than that now, which is the market, not the individual investments. The time frames will differ from the different funds that we run. Legal & General, a lot of life insurance and pension money. We would tend, with 60% of the money that I mentioned there, invest in companies between 150 and £1 billion. They would be sort of sleep easy at night stocks where we like the long-term qualities of them. We think we can own them for 2 to 3 years at least. In reality, I think forecasting the world beyond 2 to 3 years, given the last 5-6 years that we've seen, is quite difficult. But there's certain factors in businesses, qualitatively, that means that you can have a sustainable return on capital or growth that makes you happy to invest in businesses for a long term. So we're a team of 3. We have roughly 200 investments, and we need some long-term holdings that we can put £5 to £10 million into. If you consider that if you're one of the companies we invest in, we'd see the company probably twice a year, and if you do a fundraising, then we would probably do that. Then each company might need 2 to 3 meetings a year, and if we run £1 billion, and there's 2 or 3 of us, you can see that actually having a lot of investments at 1 to 2 million can be quite difficult. Having said that, and referring back to the very kind intro I got, if 60% of the £1 billion we have is in these 150 to £1 billion, £1.5 billion companies, I would say that, and that is run on W Money on a 5-year type approach. That's what our aim is. What we achieve may be somewhat less than that. The sex and violence type fund, which is the refinancings and strong growth stocks that is the UK Alpha Trust we mentioned, is probably more in the sub £150 million area, and also on the AIM market, which may be of interest to a lot of you. Now, I believe you can double your money in growth stocks if you buy them at the right price, but actually I would say over the last 3 to 4 years, quite a lot of performance has come from being able to buy AIM stocks very cheaply. And I'm afraid that's to say because the liquidity has been really quite difficult. There has been a flight to big businesses with strong yields and domestic businesses, and this can often leave some sort of middling quality businesses sort of with fund managers sort of selling shares against each other and prices becoming very low. And sometimes these can be the best bargains. So although we do buy those stocks in the market, it's not necessarily because of the really strong qualitative thing, it's maybe because we get a real bargain against the capital that has been put into those businesses. And on those sort of deep value or strong growths under 150 million, I have to say we're looking for a better return. We're looking for investments that can double on 3 years. The hit rate on that will be less than the sleep well at night stocks that double on 5 years that we hope. And in fact, actually, our hit rate on these kind of investments is of the order of about 55–56%. We've done the numbers. We're encouraged to do that for people who invest with us, which sounds very low, but it's generally quite difficult for fund managers to achieve a lot more than that. And the average in the industry might be something like 48–49%. What sort of so there you have the time frame, sort of 2 to 3 years. Often the illiquid shares, of course, if you buy them on a sort of scavenging type basis, then you have to be prepared to own them for 2 to 3 years for a recovery to take place.
Shall I jump to the next question?
Yeah.
I'm missing the second one out. I'm going straight to the third, if that's all right, because I can work out the second one. Is your fund seeing a net inflow or outflow of funds?
The retail fund, which is an open-ended fund, is roughly neutral. It had a lot of money come in a couple of years ago. We have sometimes people who run fund of funds money who will put blocks in and take it out. 2 years ago, 40 million that had gone in, 45 million then goes out sort of 9 months later, and we have to deal with those flows. But in general, in the medium term, we are seeing increases in funds under management. But right at the minute, because of some uncertainty in the market, I would say we're broadly neutral. And by way of background, it might be interesting to explain the dynamics of the small cap market. If we've got £1 billion, roughly, I would say in a year, we might take in 20 to 25 million in dividends. We might get 30 to 35 million from takeovers across the portfolios, maybe a 2 to 3% incidence there. But those funds will have to pay for any fundraisings on the existing companies that we have, and indeed any new investments in terms of new issues. And that's assuming that what we buy equates to what we sell. And it's also worth pointing out, of course, that if a new issue comes along and you're trying to float one of your clients, it may well be that you need 10 fund managers to buy the stock. If in general, as is true in the small cap market, there isn't a huge amount of money coming into the market, then those 10 fund managers may well go and sell a raft of investments that they've got. So the act of raising money for a new business may put some pressure in general on the market as a whole. So if there's too much issuance, be it for secondary financings or IPOs, it can lead to the market having a bit of indigestion.
And in terms of IPOs in the last year or so, or indeed secondary fundraisings, is there anything you've seen that has particularly caught your attention, good or bad?
Yeah, I mean, I've got a list here of the sort of general things that we're looking for. It's been the case over the last 20 years that I've been doing small companies, that the dynamic and the good thing about small companies is you get a dynamic management team that are very incentivized by their own share price and have a growth business that has probably come to the market or needs to come to the market to invest in projects that are proven. So it might be something like, Pizza Express 20 years ago had a good format that is making good returns on generating cash, but of course it needed some money to expand. So that's a very good thing. And of course, what you would look for there is not to see previous owners of the business or management exiting from the share structure. I mean, I'm sure in common with the other two speakers here in saying that what we don't want to do is just provide an exit for other people. So top of the list of things that we don't like is providing exits for VCs. And also, a really strong point I'd like to make here is I think a lot of companies on the AIM market have floated too early. And in fact, When I say that, I mean that it's not even, some of them are even pre-sale, some of them are not much more than an idea. Now, these may be technology businesses, they may be mining, they may be oil and gas or biotechnology. But I think the last 4 or 5 years have proven that it is incredibly difficult for companies that may need subsequent fundraisings to retain value in the AIM market or in the stock market. So for that reason, I think kind of companies that would need subsequent fundraising should be left to venture capitalists. And broadly speaking, new issues that we partake in, I would really like to be at least self-supporting in terms of cash. So in terms of actual specific names, we've done very well at a business called Smart Metering Systems, which, although it sounds quite mundane as a business funding gas meters, has been a very good performer in terms of profits and sales growth, and it's been a very exciting investment. That's gone from about 60p to, I think they're £3.10 today, so that's in a little over a year. We took part in a business called WANdisco, which actually had self-funded and had good sales and the ability to sell to the likes of HP and stuff in the US. It is early and it is very high risk. It's sort of 30 to 40 million market cap when it came. So a bit of an outlier for us. It's not really the mainstream of what we do, but that one again has been good. And then sort of on a more steady basis, the business called Aviva Lettings, which is a lettings agency business which has strong recurring revenues. I was particularly interested in the incentivization of the management there. The flotation process was very much, it was a continuation of a journey which had seen them grow strongly in a business model where they clearly knew what they were doing and would use the money to grow going forward.
Richard, thank you very much.
Thank you.
And now we turn to Andy Brough, who's been around a long, long time. Andy has a degree in economics and is a chartered accountant, which makes him okay in my books. In 2012-2013, he was captain of Alexandra Park's 7th 11, and I've been asked to point out that there is indeed an 8th 11 and a 9th 11. He joined Schroders in 1987, which is why I say he's been around a long time. It must be one of the longest serving fund managers with one firm. And he is co-head of Schroders' pan-European small and mid-cap team. And he has asked me to point out that he is not currently under investigation for insider dealing. I also note that if you go on the website, the captaincy of the Alexandra Park 7th 11 for 2013-2014 has not yet been announced. I think there could well be a City Diary piece here for the members of the press at some stage. Well, it may be the stigma caused by their 9-2 stuffing in October 12 to the old Salvatorians. I guess being a fund manager is not just about picking winners, it's also about avoiding the big losses. So, Andy, where would you like to speak from? Up here, or do you just want to come over and give me a slap?
I'll speak something. I'm ready for my first question.
Oh, sorry. I'm going to give you a question, yes. What are the key items you look for in the financials or narrative reports of a company?
Well, I'm always, when people ask me that question, I always draw on one of my favourite Warren Buffett sayings, which is always try and invest in a company that can be run by monkeys, because invariably one day it will be. But seriously, what we try and look for is, when I joined Schroders, people said equity is a fantastic investment because they're a great hedge against inflation. So when we're looking at a company, we try and understand, does it have pricing power? Can it put its prices up? And so we're always on the lookout for inflation or where capacity is going out. So last September, I was flying down to Nîmes on an EasyJet flight for my brother's surprise 50th. And, when you get on the EasyJet with your 3 kids and the missus, and you look around, you think, doesn't look like we can sit together, does it? You take the kids, I'll go and sit at the back. And she then produced a broker's note, quite impressively, on EasyJet and allocated seating, and the fact that we will be paying £12 each so we could all sit together for future holidays. And if you think about that, all that profit's gone to the bottom line, and EasyJet shares have doubled. You can spend your life over-analysing things, but if you can demonstrate to investors that you can indeed put your prices up, that is the easiest way for companies to make profits. So that's what we're looking at. And we're trying to stay away from things where, you know, the supply exceeds demand. You know, the internet has changed not just the high street, but huge numbers of businesses. You know, I cycle to work every day from Muswell Hill, and occasionally, if I've been out in the city for a few drinks, then I might have to get the tube. And when I get the tube, you know, I always do a bit of research. I always walk up and down the carriage to see what newspapers people are reading. You know. And on the carriage this morning, I indeed was the only person with a paid-for newspaper. The rest of them were reading Metro. Yeah. And the only reason I had a paid-for newspaper was I happened to find it. And, but the point is that whole industry. So what we try and do is take a top-down approach about what's happening and then tie it down to individual companies. Yeah? Because there's so much information in the world, you could drive yourself mad trying to analyse it. And just to use a football analogy, as Dick kindly brought up my membership of the Alexander Park 7th 11, you know, my team Spurs in 1961 won the double. Yeah? At the time, I was only 1 year, I was one, and so I wasn't fully able to celebrate what I now suspect may be a once-in-a-lifetime event. But every member of that team came from the British Isles. So you could wander around, yeah, and Fort Dunlop actually made things, and there were big Hawker Siddeley factories, and you could see what was happening in the UK, and that was represented on the UK stock market. Yeah? So wind the clock forward sort of 50 years, and the other team in North London, whose name will come to me in a minute actually, Arsenal, have virtually no English players, and that's what's happened to the UK stock market. So we'll come on and talk a bit, you know, on the next question, but the amount of information and how you process that information has changed dramatically.
I think that's the cue for me to ask the next question. Now, this is supposed to be seamless, and you're not supposed to realise that they're all preordained questions, but so I'll try and do it a bit smoother. What key points do you want to discuss at a meeting with investee companies?
What we try and do, first of all, I would ask, when you come and present to us like you would want to be presented to. Do not listen to your advisors. All right? If you like a presentation with 2 or 3 pages, just have 2 or 3 pages. Yeah? All we want to understand is, what are the inputs in your business? Yeah? What you do with them, and then what the outputs are, and all the various factors that affect them at each stage. Then we can get an understanding, we can overlay that with what we think is happening in the world, and keep it relatively simple. Yes, we'll read the report and accounts and ensure that, you know, the cash does actually arrive in the bank account at some point, yeah? And that you're not taking debits out of the P&L and sticking them in the balance sheet and calling them assets, and all that sort of thing. But we just want a really simple sort of presentation. And this lack of communication, I think, is brought about because people overcomplicate things. You know, I'm in a relationship with my wife, and it's all right, it's not a confession. And but when it comes to communication, it's just me and her with differing levels of volume. Yeah. Now, if you think of the layers between a company and the shareholders, you've got the brokers, the salesmen, the analysts, the IR, and the PR. 6 people between. Can you imagine having a conversation at home if you had to go through 6 people? Actually, that's not such a bad idea. But those 6 people give you a message that they think you want to hear. Ignore them. Ignore them. Just present to us like you'd like to be presented to yourself.
And
right.
is free float an issue for you?
Free float? No.
Thank you very much. Now to Robin West. Robin has a degree in natural sciences from Cambridge. He is a chartered accountant, and he's been at Aviva Investor since 2004, previously working at Oriel Securities and Invesco. I've got to ask you a question.
Excellent.
Fine. Robin, what effect will the government's move to incentivise investment into small and mid-sized quoted companies, e.g. removal of stamp duty on AIM ISDX shares and the inclusion of AIM shares into ISAs, increase in VCT EIS limits, what effect will those have?
Well, I think looking at each of those in turn, in terms of stamp duty, anything that reduces the cost of transacting in small company shares is clearly beneficial. However, like Richard, and I suspect Andy as well, we take a long-term view to our investment. So the turnover in our funds tends to be pretty low, and therefore the transaction costs as a percentage of the fund are low as well. And just because there's a tax benefit or a lack of cost to trading in a share, that won't automatically make me more interested in trading the share. It's all down to the individual business. Is it a quality business? Can I see that it's going to deliver growth, and can I see that the share price is going to deliver me a good return? So it is clearly helpful, but it's not necessarily going to change the amount that we invest in or allocate to AIM within our portfolios. Currently, we've got about 20% or so of the funds in AIM stocks. I suspect that may come up a little bit, but it's all very much down to the individual stocks and the quality of those businesses. In terms of the ISA allowance, I mean, to my mind, I don't understand why ISAs, you can't put AIM into an ISA, particularly if you look at some of the AIM stocks. You've got high-quality businesses, say something like Majestic Wine, which is a good, solid business, versus on the main market, you can have some higher risk businesses. I mean, I think the argument for not having AIM stocks, including in ISAs, is because they are higher risk. And as I say, I think it's a case of let the investors decide whether it's an appropriate investment for them. The retail punter is a useful source of liquidity for smaller companies. A lot of the businesses that I invest in, they'll have 10-20% of their business held by retail investors, and as I say, that helps if you've got a lot of institutions like myself and Legals and Schroders who are long-term investors and therefore won't be trading those stocks as often. It's useful to have more retail punters on your shareholder base. So again, I think that's a helpful step in the right direction.
Thank you. And I've got to add that my 11-month-old grandson will be withholding his vote at the next elections unless and until we do get AIM stocks into ISAs.
Excellent.
The session after lunch is about corporate governance, and I think it's quite interesting to ask you, Robin, what key corporate governance features do you look for, either no-nos or absolutely must-haves in the businesses you want to invest in?
One of the things I do when I'm analysing a company is I look at the structure of the board, and I'm looking to see that we have experienced and independent non-execs on the board. Non-execs can add a lot of value to businesses of all sizes, but I think particularly for smaller businesses. And it may be that the business and CEO doesn't have direct PLC experience, and so that can help. It can help if you've got an ex-FD of a listed business on your board who can advise you on things like making sure that your forecasts are appropriate and are realistic. And also, you want to have non-execs who have relevant experience of that industry. I mean, if you've got a complex technology, it's important that you've got someone who understands that technology on the board. Equally, we look for management who have direct ownership of equity. Clearly, you'll be incentivised through various long-term incentive plans and bonuses, but if you are enthusiastic and believe that your business will grow over the years, there should be no better place for you to put some of your wealth into that business. It's business you understand and you know, have a strong feeling of how that's going to deliver. And we'd look to say we want to have an alignment of interests and look for direct ownership of equity. It's important for us to see appropriate incentive structures in place. We want to see that you are incentivized to grow your business. What I'd say is that against the trend of what the EU has been speaking about in terms of reducing levels of performance-related pay, we are actually would look for lower base salaries and higher performance-related pay. That to us makes a lot of sense. Clearly, that performance-related pay must be suitably challenging, and you'd look for, at a minimum, to be paid out delivering the expectations you put into the marketplace. So that should be the starting place. But we are not averse to people earning large payouts if you've delivered exceptional performance. That's say is good alignment of interests. I know one of the questions or comments that came back from the previous session was in terms of fund manager feedback. And we try to be open at the meetings and ask companies, do you want to give us, are there any questions you'd like to ask us? And equally, we would encourage chairman and the SIDs to put the odd call into your major investor to make sure that are there any issues that you have? As Andy was highlighting, there can be lots of levels of advisors in between the company and the fund manager. And the risk is that we get phoned up to provide feedback after a meeting, but that gets sanitized. It's a bit like Chinese whispers by the time it gets back to the company. So if you are a chairman or a SID, put a phone call in. It doesn't once a year to your key investors to ask them what they think. And I spend a lot of time going out visiting businesses because I want to meet not only the management, but I also want to see the strength and depth below the management. So succession planning is something that's important, and it's important that it's not all down to one individual.
Robin, thank you very much. We now move to questions from the floor. You've got three heavyweights up here. Please raise your hand, wait for somebody to scuttle over with a microphone, tell me who you work for and what your name is, and let us have your question. Gentleman down here in the orange tie.
Thanks. Hi, I'm Charles Skinner. I'm Chief Executive of Restore PLC, and I've been running quoted companies for almost 20 years. Can't complain about the markets. The current one, which we supply office services, so anything from storing your cardboard boxes to moving your offices. So do come and talk to me if you're interested in those services, but that's what we do at the moment. I can't complain. Our market cap's gone from less than $1 million to 100 million, down a bit in under 3 years with 5 successful placings. The reason why I think some of us prefer running quoted companies to running private equity companies is that it's extremely difficult to motivate your staff in a business which you know all you're trying to do is flip it in 3 to 4 years' time. And so we're extremely delighted to be part of the quoted market environment. A real frustration, I think, for a growing business in this space is how the markets open and close. And over the last 20 years, I've known times when the markets have just been closed. And it's extremely difficult to run a business looking at particularly acquiring businesses and looking for that development capital. And it's a disadvantage that we face in this industry. As a private equity-owned business, you know that the funds will be there when you need them. And much as people are very rude about the banks, one can warm up the banks for opportunities, etc. Whereas there have been times when, because the markets are fickle, because investors lose confidence, or they actually haven't got the funding around at the time, that one's plans are much weaker than they would otherwise be. And certainly when one's looking to do an acquisition, the idea that at the end of it, when they say, well, how are you going to get the money for this? It's okay, we'll be able to place the shares, and you've got your hands, you've got your fingers crossed behind your back. So I'd like to understand more from our three illustrious panelists about what they do, about how they can prepare to make sure that businesses like us, when we come to them, and the point is well made, if you're going to be quoted, you've got to want to have some shares, you've got to have reasons to be quoted, about how we can feel fully confident that if we're fulfilling all the criteria which you illustrated about hitting your numbers, never letting the market down, how can we know that the funds are going to be there? And as an ancillary question, I'd just like to ask, it was very interesting how much interest the man from S&P got in the earlier session. At the moment, we're a 100 million, 90 million pound business. We have one in-house broker. There is very difficult to get what the view is about. Obviously, we've got sponsored research, which doesn't seem really to be rated by anybody. What their views are on having very little analytical comment nowadays, which we fully understand is because the financial dynamics don't work.
Thank you. So it's two questions there. One, how dare you hunker down and not have money available for investment at points in time, is point number one. And point number two is, how do you feel about only having one broker writing about a company? Can I toss it at Richard first, because he's closest?
Yeah, in terms of only having one broker, clearly we'd be better to have more, but you have to look at the economics of the whole process. Notes don't write themselves, and actually commissions are going down, which, I mean, the impetus to push commissions down has come from the institutions, which, of course, we three represent. So unless we pay more for sort of secondary research, then there's less provision of those notes and the research to have an independent view. In terms of having the money available, I mean, clearly the question is to the people that are here. I mean, the interesting point, though, is that there are less institutions available or investing in the area of the market under £100 million. And part of the reason for that is that actually, I mean, if we refer to AIM in particular, or the fledgling, which is under 100 million, returns have not been great since the AIM market was launched in 1996. For what is an earlier stage, riskier marketplace, you would expect returns to be in excess of the small cap or the Hall-Gavette markets. In fact, they're substantially worse, even if you allow for, as somebody rightly pointed out, the fact that sometimes the better stocks do graduate up. So one of the questions is, I appreciate I'm not directly answering your question, but the money that might have been available 5 or 10 years ago from other institutions who by definition wouldn't come and present to you because they're not invested in this area, to some extent money has been going away. There is less money to go around. And basically, when we are asked whether we would like to invest in something, it basically, to get in my portfolio, I have to make enough of a return on the new investment for it to displace something else if I can sell it. And the ability to sell something is, of course, a function of whether somebody else wants to buy it off me. So even if your next fundraising gives me a return of 40% and my average return on the fund is 28%, and I could perhaps lose something where there's only 10% upside, clearly it would be in my interest to make the trade, but it's a question of whether I can sell the investment that I've got that's only got the 10% upside to somebody else who will free up the cash to give you the money for the new shares. And the markets are a lot less liquid than they were because there's a lot less participants.
Richard, thank you. So give us something better to invest in and we'll find the money, I think is what you're saying.
No, the point is there's less liquidity, there's less institutions doing it.
I mean,
Would you like to add anything to it, Robin?
Yeah, I was just going to say, in terms of, I mean, we would look to support the businesses that we invest in, and certainly if I've got a choice between investing in an IPO, which has an unproven track record, or one of our investors, investee companies coming to us saying we've got a cracking acquisition, we need capital to fund it, I'd far rather back someone that I've known and invested in for a number of years, coming with a sensible deal, than someone who is fresh to the marketplace. So we would toward, I say, we would try and be supportive of our investee companies. Clearly, there are times when the markets are generally shut, when we're nervous about having cash withdrawn from our open-ended funds or asset allocations against us, and therefore you don't just physically have the cash to be able to invest in those new ideas. But I'd say at the moment you're seeing a better IPO market. You're seeing fund managers are interested in seeing new ideas, and we're certainly supporting fundraisings. And on the research side of things, in my view, the quality of some of the paid-for research is clearly a concern about independence, but the quality has improved dramatically over the last 10 years. And you know, someone like Edison, I'll regularly read those notes. Their notes are distributed on Bloomberg alongside other people's research. So although it may be difficult to get an independent broker to provide research, I wouldn't discourage you from looking to supplement the house broker with paid-for research.
Would you like to add anything, Andy?
Well, yeah, just a couple of things actually. I think on this research thing, I think companies can do a lot more for themselves in describing their business in the report and accounts. I mean, I sit on the judging panel for building public trust in the future. And you take someone like Provident Financial, they managed to explain the whole financial system in 2 pages and where they fit in. And with websites as well, I think that's going to become more and more a function of not just reaching institutional shareholders, because the whole thing's fragmented. When I joined the city in '87, the M&G, as they were then, Schroders, Galt no more, and UBS effectively controlled the London market. Now we've probably got about 8 or 9%, and it's become completely fragmented. So research doesn't actually do it for a lot of people. They find these companies through their performance, and they find them, and with the websites now, I think it's far more important. And the way the compliance is going in this country, it's the fastest growing area in the city in terms of hirings. Then if the ability to give people favoured information, if there ever was anything like that, has gone. So increasing the use of websites and reporting accounts effectively creates a level playing field, and people can make their own decisions. Just on fundraisings, I mean, call me old-fashioned, but I thought that's what underwriting did. Isn't that what you pay your fees for?
Thank you. I mean, in terms of paid-for research, you can go to the formal houses who we all know you pay for, but you can go to other frontline type brokers, particularly the private client brokers, and give them a quasi joint brokership. You're still going to pay for it, but you can't get much for free in this life. Next question, please. A gentleman over there in the lilac-y looking tie from here, but the coloration is not good from here. It's the light. It might be my eyesight, which is why they don't let me design pots.
Edward Beale from Citigroup again. As fund managers, how important is it that you meet the chairman at results presentations? And if it is important, what do you get from such meetings?
Do you want to meet chairman? Shall I start in reverse order this time? Robin at the far end.
I mean, it's, the answer, I mean, we quite often have chairmen attending meetings. They'll come round on maybe one day of the roadshow just so that they're hearing, as I say, direct from the horse's mouth, so to speak, what our views are. We would welcome to have contact from chairman both through the roadshow or on an ad hoc basis. The odd phone call, say once a year, just to make sure that there are no concerns that you haven't been made aware of through the other feedback loop. So the answer is yes. We also aren't shy of picking up the phone and calling chairman where we perceive there are or we have concerns with businesses.
Yeah, I mean, we only see chairman when we've got concerns. So if you are called to Schroders' office, then it's not to tell you how well you're doing.
Richard?
Yeah, I think the odd phone call once a year is probably about the right approach. Often the chairmen that are most conscientious and want to come and see you are the companies where there's an open dialogue and you don't need to see them. The ones where they don't come and see you is where the chief exec and the chairman are often the same person or not independent, and you need to pick up the phone and place the call the other way. So.
Anybody else? Down here, gentleman in a stripy tie. I don't know what we're going to do when a lady raises a hand, unless she's wearing a tie.
Mr. Steele, Richard Penny and yourself have both alluded to lack of new funds coming in to the fund managers for investment. And that's something which strikes a very cautious chord with me, because if the investment community have not got a constant inflow of funds, then we almost come to a zero end game. And if you have to liquidate your investments in order to make a new investment, that's a new phenomenon for me, because I guess it's coming from lack of pension fund contributions or some other change in the cash raising process or cash flow process.
Well, it's coming from two areas. If you think money comes from two areas, it comes from institutional and it comes from private clients. Yeah? So institutional, the money is allocated and decided by investment actuaries and consultants, and they are paranoid about risk. So someone like Richard's fund, which aims to do, what do you say, 40%, would be so far over there that it would only be a brave consultant that would even think about it. Much better to go for bonds. And so you've seen a massive sort of drip away from UK equities in large pension funds because they've been perceived to be too risky. Far better to lend to a company which has a deficit of 120 billion a year, sorry, the UK government, than a cash-rich company. And that trend, until it's reversed, it makes it very tricky. Now, in about a month's time, we're going to be pretty close to the bottom of 2008. So all three of us are going to look like absolute superstars, yeah? Because our returns over that 5-year period will be between 50, 70, 100%. And the consultants will probably look at that and think, now is the time to get back into equities. But I don't know what you two think.
No, I think you are starting to see a bit more interest in the space. We're having some incoming calls, which is you don't often get in the small company space. I was reading a note the other day. I mean, small companies over the last 5 years, I think, or last 10 years, were the fifth best asset class globally, UK small companies. So again, that encourages some flow back in on some more interest in the sector.
Yeah, I think the funds being raised is probably at a low relative to the performance that we've had, and there is value in certainly at the bottom end and in the AIM market. But in general, money had been going over the last 5 years into fixed interest because of the risk aversion that people had. And I'll go back to the point I made about the AIM market in aggregate, is that I think since it launched, it's down 30% and the market's up 140 odd. You would expect the AIM market to have done better because it's a riskier, more illiquid asset. And so at some level, the companies have been floated at the wrong price, or the delivery of the underlying has not been good enough, or bad companies have not been screened well enough. And that has damaged the prospects for AIM as a brand from raising money. Now, if it was protected slightly better, and that's down to the stock exchange and all participants, then we'd have a better peer group to invest in, better list of investee companies, and there would be more money willing to go for the small companies in general.
Anybody else? Lady down there by the TV camera.
Hello, my name's Susan Robertson. I'm the CFO of Oxford Catalysts. We're a name-listed company. And my question, going back to the title of this panel about the liquidity, It seems to be, in our experience, that the fund managers have been great for getting long-term support and getting fundraisings, but not necessarily in helping just the general liquidity in our shares. Is that a fair comment? And if so, what else would you recommend that we should be doing, or what should management be doing, apart from just talking to fund managers? Where else should we be looking to improve general liquidity?
Can you just clarify what you mean by sort of how we could help with general liquidity? Is that sort of being a buyer of last resort idea?
I suppose what I mean is that we can look to the fund managers for raising funds when we come for a fundraising, or where there are large blocks of shares available. But when there's not much going on in the market, our share price tends to sort of drift downwards on very small amounts of very thin trading, basically. And so for a name-listed company, having a thinly traded share means that your share price, it's hard to kind of keep its value.
Sorry.
Yeah, go on, Rob.
In terms of that, I mean, we will subscribe, large sums of money, £1 million here, £2 million there to the fundraisings. And then we may well take out blocks of shares in the secondary market, but it's often lumps of £10,000, £15,000 that will impact the share price. And sometimes people can manipulate this if that's what they like to do, which is technically illegal, but if they're not highly regulated and they work from home, then they may do this. But so it's quite possible that we could buy £1 million worth of stock today, and the next day somebody could sell £20,000 worth and move the price 5 or 10% against us. If anything, that serves as an argument for us not putting £1 million in the first place. I mean, the problem is with the market, there are less market makers there who who will absorb the stock. I mean, it used to be something that a broker might have thought to do in terms of absorbing stock from private clients, the retail punter or whatever you want to call them, and to piece that up so that it could then be moved on to an institution should they want to buy it. But there's often liquidity in shares. It's just that the prices just move around hugely. It's and we, if I bought the £1 million, I don't necessarily want to buy the 25 tomorrow and the 10,000 the day after that. It is a problem of the market, and I don't know what the answer is, but you're right to flag it as a problem.
Robin, did you want to make a comment?
Yeah, I was going to say, I mean, the problem you describe is it's not unusual in small companies, and say there's a disconnect between the unit size that we want to deal in and where, as Richard said, we'll buy £50,000-100,000 worth of stock, but there's a cost involved with trading, so there's got to be a minimum size. So you do need to try and encourage market makers. The other thing is to make sure that you have a decent amount of retail interest in the business as well, because if they can trade, if you have the man on the street trading amongst themselves, then that will avoid some of the spikes in volatility. So perhaps seeing some of the private client brokers and the like can help in terms of broadening, so you have a core institutional shareholder base, but as I say, maybe 10-20% of retail who tend to trade more frequently.
Andy?
Yeah, in your case, I would argue that Oxford Catalyst is an impossible business to value, right? Because it could be worth £100 or it could be worth nothing, right? So, and that's just my view. And everyone's going to have a view, and they might feel more optimistic one day and less optimistic than another. Because you've got no yield support, you've got no net asset support, that's what's going to happen to your shares. Some days they'll go up for no apparent reason, and some days they go down for no apparent reason. Imagine having a whole portfolio like that. Yeah.
Interestingly, on the subject of liquidity, we have 3 big supermarkets in Burton-upon-Trent. Nobody else knows that apart from me. It happens to be my local town. And the market hall, the covered market hall, which is closing down. And I actually blame East Staffordshire District Council for not working hard enough on it. But if the volume isn't there for the market to attract the market stall holders, then people won't go. And if people won't go, then the market stall holders won't go. And it snowballs, but backwards. And we found on our Portmeirion journey that as you got bigger and bigger, it got better and better, and you became more and more visible with more and more turnover and a higher market cap moving you up the process into slightly bigger funds. I'm going to turn to Tim in a moment for a question, but if you, this slide, if it works, this is a summary of a slide on page 64 or 65 of the stock exchange booklet explaining how the AIM market works, and there's a lot of detail within these individual headings. I really would encourage you to pick up that stock exchange booklet and look at those slides and just think about all the little things you can do with your business that will make your shares more liquid. And I'll come back to the point and say you have a fiduciary duty to make sure there is a market in your shares if you're listed on any stock market anywhere. And there are some pointers in there, and if we just stopped in Stoke making cups every day and didn't get out and about, then we would have a thin market in our shares. Let me now turn to Tim, who was waving at me earlier with a question.
Yeah, I just wonder whether you could describe what you'd see as being the characteristics of an effective stockbroker.
Good lunch.
So, did you say good lunches?
Yeah, good lunch.
Yeah, that's good.
Yeah, I mean, I think the job of the stockbroker is not just to place the secondary line of stock or to introduce the company to the market, but it's to ensure that the right institutions who will look after the shares in the right way will be put into it if they can attract those. And if they can't attract them, to price the thing more favourably so that they do get the right institutions that match the company that wants the money's needs. Having said that, I mean, because of the way that the stock market's been going, there is an impetus for brokers to raise fees, and there can be too much of a concentration on staging a roadshow for the company that needs to raise 15 million quid, for which there's a 4% fee, rather than actually looking after the shares of the one you did last week. I'm sure if I was in the broker situation, I would probably behave in the same way. But the unfortunate thing is that if you place the deal last week and then perhaps like Oxford Catalyst, the price comes under pressure from a very small amount, that becomes quite an unpalatable experience, and the institutions will not go back. So, you know, we'd look for brokers to look after the share prices insofar as they can.
I mean, David Mayhew, who obviously knew a bit about this, always used to say to me, you know, his job was to get the best institutional list he could at the best price. So kind of everyone left the party with a balloon. Yeah? And it is pretty tough in a world where commissions have fallen so low that and will keep falling, that reliance on primary and secondary fees leads to a distorting impact, I think.
I think what I'd add is make sure that it's someone who the analyst really and the broker really understands your business. I mean, if you want to ask us on a case-by-case basis, who do you respect in whichever sector, who should we be looking at? But when you're choosing a broker, make sure, as I say, the analyst is well respected. You can look at the surveys, which give you a picture, but also speak to the fund manager, and also make sure that it's a broker that deals with your section of the market. There's nothing more frustrating for us as fund managers, particularly on IPOs, where A, you have a cast of thousands on the ticket, and B, it's dominated by people that you don't speak to on a day-to-day basis, who are only there to raise the money for the business, and then it's on to the next deal, and won't provide the research support afterwards. So your good, solid UK mid and small cap specialists is where we'd like to see our investee companies placing their brokerships. I
would certainly endorse Andy's comment about a good lunch. I started raising money in the city in 1987, so I've been at it quite a long time, and I can still remember the last good working day lunch I had when the port came out about 3:30, and that was at Cazenove. And that was in 1996, and that's just gone downhill since, hasn't it? It's sandwiches, and they're normally funny sandwiches that you get down here in funny kinds of bread with funny things in the middle, rather than just plain ham or plain cheese, which I really understand. Right, where can we turn next? Anybody else got any more questions? There's a gentleman down here in glasses, and then I can see a gentleman, Paul, in the back there.
Hi, it's Matt Wood from CMS Corporate again. It was picking up on an answer that Richard gave to the gentleman here about new inflows into the market, and your response about the AIM index itself not performing particularly well. But then you said in your bit that you're a stock picker. So how do we get the impression across that actually you don't invest in AIM as an index, you invest in stock picks and you use the likes of your experience to do that, to encourage more inflows into AIM, which will then get the liquidity going?
I've actually made reasonable money out of the AIM market, but quite often it's from buying things very cheaply that other people have thrown out. So maybe I'm a pariah slightly of what goes on in people's day-to-day things, but I will also refinance businesses when other people won't, and that's quite a risky thing. Some of them work very quickly, some of them sort of go from one problem to the next. It's a high risk thing for which we expect a reward. I think it is very stock specific. You know, the essence of a good small company, the reason why I would do this rather than be doing large companies where they're all very safe and you'd like to send your kids to work, is that if you get a good small company that's got interesting growth projects in a growth market with a good return, you can make a really good long-term return far in excess of what you can get in a large company environment, and you can understand the business quite well, and you can meet the management, and very soon you can meet most of the people that make the business work. You can understand why they get out of bed and go and do it, and you can some ways you can understand the relationship between the share price and them being motivated by it. How you asked the question, how can we is a different issue, but I think there needs to be more of a concentration on the sorts of businesses I've just described, so less exits for VCs. I have made money on some of the overseas businesses that floated in the UK, but only after they've floated and subsequently disappointed, and I bought them very, very cheap relative to the money that's been put into them. So without singling out particular geographies like India or China or yes, Eastern Europe, you know, often these things float, and there are different business ethics there. It's just a cultural thing, and it's very, very important to understand those, and we don't choose to make a quality view when these things float, but often we may take a look at them in a year and a half if there's been disappointment. So I think actually having tighter restrictions on what's allowed onto the market in the first place would help people concentrate on the qualities. And, you know, Dick outlined his business, and that sounds like the sort of business that people like to invest in. But if there's too much other stuff out there, people can't see that and identify with it and invest in it.
The London Stock Exchange spent a lot of time going around the world offering what was hence the number one stock exchange in the world, and promising access to a load of Russians, Kazakhstans, anyone for fees. And they have single-handedly wrecked the market, right? Now, and that's why they diversified their business, right? They bought FTSE, anything, just get away, reduce the impact of the London market, because they have let all these rubbish companies floated, and until they've gone, then it's going to be a struggle. And it's not just AIM. The FTSE 100 still trades 1,000 points below its peak because the whole mining sector has collapsed. AIM is just, you know, a magnified version of that.
Well, I think just on a slightly positive note, there have been some great success stories on AIM. You look at ASOS, you look at Abcam, you look at Majestic Wine. These are businesses that have grown into substantial market caps and have earned pretty high multiples. So we need to focus on more of those type businesses and less of the overseas where there are the governance and the other issues.
I think the governance point is well made. I mean, generally, I understand Midlands businessmen. I sort of understand people down here. As I get further away from my comfort zone, I understand their morals and their ethics and whatever less and less. And sometimes I think we lose sight of how, if you go back probably pre-Big Bang or shortly afterwards, how the city was still, in many ways, an old boys' network, and people knew who was a good un and who was a bad un. And there was less reliance on just box ticking and box ticking. So Paul over there, right in the corner, and I'm being waved a red piece of paper, which means that this is absolutely the last question. So make it a good one. I do sound like Paddy McGuinness, don't I?
Hello, Paul Clark, non-exec director of various companies. When I was a young lad, when Spurs won the double, which I do remember, Andy, the institutions had a lot of money coming from defined benefit pension schemes. At the time, they seemed to be the biggest provider of funds. Defined pension schemes have collapsed virtually. Defined contribution schemes are not getting the same money. Companies are saving themselves 50%, 75% of the cost of running a defined pension, of a pension scheme. That was a huge source of money into the London market. It was a huge source of liquidity. There's also a bit of switch to bonds as well. But has anybody ever measured, I don't know the answer to this, the difference in monies coming into the stock market from pension funds adjusted for inflation, etc., compared to what it was 20 years ago? Because to my mind, it seems to be far less money coming from institutions, hence from pension funds, hence much less liquidity. Is that just a myth by me? Or
Thank you. Of course, we shouldn't lose sight of the fact that in a brilliant sleight of hand in 1997, Gordon Brown took 20% off the income flow of most defined benefit pension schemes, and it went unnoticed. Let him try doing that with public sector pensions and see what happens. Gentlemen, any comment on that? Lower investments from defined benefit pension schemes?
I wish you luck in trying to work out that number.
I think there's a secondary issue, which is that actually more of the money that's been coming in has had to go into fixed interest type investments where you know what the outcome is going to be, and that's because of the regulatory environment for insurance companies. Yeah. So actually, the amount of money that life funds and pension funds have in equities has gone down significantly. I'm going to quote a number. I think it's gone down from something like 60% to 30%. And that's in aggregate, so marginal flows have been going into the other areas. Of course, if we get a collapsing of the fixed interest market, then it may well be it has to go into property and equities, and that could be a very positive environment, not least because if you're in small companies that are illiquid, any kind of flow coming in could have a disproportionate effect.
Thank you. Robin, anything to add?
I think the only other, there's clearly as the defined benefit schemes are closed, that you get more defined contribution and SIPs, and certainly, if I'm a case in point, the majority of my SIP is invested in equities rather than in fixed interest. So you will, as that pot grows, I suspect, see some of that starting to flow back. But like Andy, I have no idea what the number is.
Thank you. Now, at that stage, I have to draw a halt to it, otherwise Kate's going to come up and slap me. So if you join me in applauding, and thank you very much.